Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I'm delighted again to be able to speak to Jamie Constable of Singers, one of the UK's finest capital markets experts. So welcome, Jamie.
Hi, Paul. Great to see you again.
Yeah. Well, given all the recent angst over rising inflation expectations, we saw that this morning, and alongside sort of rising bond yields, but now being joined by new lockdowns actually in Holland and Austria. What's your sort of outlook for 2022? Because I know you've got a new sort of like strategy, I understand.
We're going a bit more cautious on the domestics, basically, on the UK domestics. So why is that? I mean, it's the drag you're going to get, basically. Obviously, 2021 we've had the reopening, so that's obviously boosted lots of things. And as I like to say, it's the Delta that moves markets, not the Delta variant, but the Delta as in the change. And what we're seeing there is 2022. There's a lot of drags. You've got inflation. What was it? 4.2% this morning. Yeah. I mean, the Bank of England, I'm looking out the window here at the moment. I mean, they seem to be sleeping on the job a bit, to be perfectly honest. I mean, they seem to want to see every stat they can see before they'll do anything, because, I mean, there's a stunning stat that 2 million job changes happened in the late summer. So 1 million people went into jobs, and there's 1.2 million vacancies out there at the moment, and jobs actually went up as furlough ended. People in employment went up. So that's obviously a positive for the consumer. But on the other side of it, you've got these drags of inflation hitting disposable income, and then you've got energy prices rising, which we all know.
I have noticed that, because I've just been kicked off my old provider and I'm paying twice as much as I was before. Double. I mean, it's unbelievable.
Yeah. It's and there's more going by the day. I mean, the gas price is going up again now because of the pipeline not being approved, and Putin basically controlling Europe on what, being controlled almost of what he wants to do there. So you've got that, then you've got the tax rise coming through. Don't forget, UNI is going to go up in April as well. And then you've got council tax, which I'm sure that's going to be a reasonably hefty rise as well. So that obviously will affect consumers' disposable income. Which areas are most protected, I think, is what we should look at. Well, the minimum wage has gone up by 6.6%. And it's interesting that what's happening at the moment is that the lower quartile of pay range, pay people in the country, they're the ones that are seeing all the big pay rises. That's where the shortage of jobs is. And that's actually very good, because those people spend. The propensity to spend is like 120%, i.e. they spend more than they've got. So that's good. They will be squeezed like everybody else, but they've got jobs, they're doing well. So I think what I favour down there are the kind of companies like Studio, the online retailer with credit like that. I think that's in a good spot. And it's that end of the market that I favour.
The value end. You're talking about the value guys, yeah.
I think the value guys, because they're the guys that benefit. People trade down their benefit. But you are going to have this drag. So, yeah, a bit more concerned about that. What I do want at the moment, because of the huge amount of inputs that management are having to deal with, we talk about it, don't we, amongst ourselves, and it's hard enough for us to kind of weigh up everything that's going on. If you're the manager of a company at the moment, and normally you've got the normal inputs, but then you add on inflation, then you add on employees asking for pay rises, then you add on supply chain, and then the list is just endless. You want quality management and quality earnings really at the moment, or an area of the market where you're seeing secular growth, because there's a lot of headwinds at the moment that management are going to have to fight.
Yeah, I would agree. I think certainly with companies with sort of pricing power or driven, the growth is driven by secular. But let's just sort of like unpick some of the consumer, because you talked about the sort of value side should be relatively, protected. And also sort of, if you look at the top end, I mean, the country, just look at the fund managers, how much cash they've got swimming into their funds this last year. The savings rates are still very, very high. And let's just assume that salaries do stay relatively flattish, etc., going forward in terms of real terms with regards to inflation.
You need 4% rise for real term flat, don't you? Yeah. So
yeah. So in real terms, if it's sort of flat, they're flush with sort of like say high savings, and there was a lot of pent up demand. So I would just been playing devil's advocate. 70% of the sort of people who everybody who's in work, which is obviously the large almost 70% of the economy, not quite, but they should do all right. It's the people, unfortunately, who haven't got jobs, who are on in universal credit, who are really going to struggle, all the pensioners. And you know, if you run that scenario, just playing sort of devil's advocate, essentially what you're going to get is such that, you know, you're going to get obviously more wealth inequalisation, which is obviously not great. But the Bank of England seems to be adopting, to me, a deliberate policy of trying to soft land the economy on an inflation rate above 2%, at sort of like probably 3% or even 3.5% longer term, so we can actually reduce the nation's debt as a percentage of GDP over time, which is frankly a move. The movie that was the movie which came out of the Great Financial Crisis in 2008. I mean,
well, deflate the debt is obviously one way of doing it, by having inflation run hotter. So they can do that, and obviously they've got the huge stock of gilts that they've got that they own at the moment, 40% plus of the whole market. So I think it's a very dangerous strategy to follow, to try and do that, to try and, you know, because once what you have to worry about in inflation is wage inflation. If you get a wage rise spiral, I'm not saying we're going to get that, but if inflation expectations rise, that will have an impact on people's spending. What will they cut back on first? They'll cut back on high ticket items, because, you know, that's the first thing. You don't go and buy, you know, will they cut back on housing? I don't know. It's still very affordable, but they will cut back on the high ticket items first. So that's the area of the market, again, that you need to be more cautious on. And the essentials and the value, I think, is where you want to be. In terms of pensioners, I think pensioners are relatively well off, because, okay, triple locks is not going to be honoured, but they're still going to get inflation-ish or plus pension rises. So I think they're relatively protected. Yes, the people out of job, you're quite right. The people without jobs, they will be under a lot of pressure. But let's not get away from the fact here. There's 1.2 million vacancies out there. I think it's not for the want of not getting a job. The jobs are out there if you want to get them. There's plenty of jobs out there. So are we at full employment? No, that's a silly thing to say. I don't think we are. But the unemployment level is right back down. And the underlying rate of wage growth is estimated by the Bank of England across the road here somewhere between 3 to 5. So it's around inflation. If that starts moving up, then it's quite a big problem to unwind. I mean, you and I can probably remember just coming out of it when we came out of it in the
70s.
Yeah, late 70s, 80s, and distant memory, but it's a tough.
I think the big wild card is the currency. If basically trying to run the economy hot consistently at a higher level of inflation than his target, which frankly is what I think he's deliberately doing, because that's what the rest of the world are doing, trying to.
Well, look at the US.
Well, exactly. They're all doing the same strategy, because they have to.
6.2% in the US, and he said he could have it either side of 2. Well, he's got to go to -2 now to make up for the 6.2. But anyway,
we can throw the 2%. But the biggest curveball I can see with regards to inflation is actually not wage growth. It's actually if you get a currency devaluation. But because everybody's playing the same game on a relative basis, you're going to see asset prices increase. But in relative terms, in exchange rates, they may stay relatively, sort of like in parity, because everybody's adopting the same strategy. But you're right, it is dangerous. And just moving now to sort of like other stocks you're interested. I understand you quite like the sort of the overseas reopening played on the beach, for instance.
Well, yeah, I mean, on the beach I've liked it for a little while. It's not been right. The shares are absolutely collapsed. But just from personal experience, I mean, booking holiday at the moment, the flights are booked up. It's hard to get them. You ring holiday companies and there's limited stock, and that's okay. It's the winter sun kind of bit at the moment. But as we look into summer next year, ask yourself, are people going to do a staycation again, or are they going to go abroad? I mean,
that's an easy one.
Yeah, they're going abroad, aren't they? They're going abroad. And there's stocks like Saga, talking about the pensioners. Yeah. I saw a big director purchase there as well over the last 24 hours. Saga, TUI, on the beach. These guys are going to benefit. So I think we've got to look forward on these things, and looking on a 12-month view, these guys should have a great year next year. So, and the consumer, we know what their holiday's sacrosanct. We said the consumer might get squeezed a bit, but they're going to go on their holiday. They're going to book up and they're going to go on holiday next year. So
I totally agree. I think that's, it's a no-brainer. The overseas holidays are going to go boom, boom, boom next year.
Yeah.
So,
yeah.
Another one on the consumer side, which is, I think I probably have a different opinion, is basically the housing market, because that's shown a lot of resilience in terms of the sort of house prices and wage inflation and supply chain bottlenecks. And my sort of preferred play is a sort of premium brick manufacturer, which is called Michelmersh. And the reason why I like that is basically 50% of its business is in repair and maintenance, and sort of like. So that's all very recurrent, and that's going really well as gangbuster. But also houses, in terms of everybody wants to live in something that is actually more attractive, and it does the premium brick. If anybody understands what a premium brick is, they can tell me, send it on a postcard. But essentially, it means aesthetics are a lot better. That's what it comes down. It looks a lot better. But the secular drivers, the industry. It's an oligopoly, basically, the brick manufacturing. There's only 4 people and 3 large ones, and then there's the premium guy who's obviously Michelmersh. So in terms of pricing, the margins should do well, and the share. All I would say is that when investors have a look at the sort of the whole sector, the building sector, don't throw the baby out with the bathwater, because
I totally
everything's come down, and basically Michelmersh is currently trading less than 8 times EBITDA now. And frankly, that's on modest expectations. And I would say it's a minimum of 10 times EBITDA. And when you run those numbers over sort of like a 5-year period, you get sort of like £2.60 compared to the share price of 120. So, I would have a look at there's some opportunities in the consumer, even though they're going to be squeezed.
Totally agree, Paul. I think there's opportunities there, and totally don't throw the baby out with the bathwater. I mean, look at we've talked about infrastructure, which of course is building as well. I mean, that's happening. HS2, okay, they're reining it back a little bit, but that bit was going to be built years in the future. There's massive demand there. You saw that Speedy Hire today have upgraded expectations.
Yes.
Shortage is great for these guys because rates will go up as well. So the manufacturers can't produce whatever they're renting out, whether it's a drill through to a high platform or something like that. Well, we all know what happens. Supply and demand, rates will go up. So I think, yes, there are good areas of the market to look in. The house builders are pretty much sold for the next year. The key on that is how much interest rates go up. But the demand's out there, as we know. So,
and I can't see interest rates going up. That's for sure. I can see mortgage availability reducing, but because I think mortgage rates will go up because they will be reflected the bond yield.
They are.
Yeah. But when it comes to actually interest rates, they're going to nail it to less than 1%. It's going to steepen.
Got to steepen. The curve has to steepen sooner. Well, it did, didn't it? It steepened, and then of course we had the statement saying that we're not going to do anything, and then of course and to be fair, the UK moved the whole world bond market. I mean, it's quite amazing. The UK managed to move the whole global bond market on that, and a lot of people lost a lot of money. But now it's starting, as you said earlier, to creep back up again because you've had these numbers like 6.2 in the US, 4.2 in the UK. Job vacancies anyway. We've talked about that. So but I think the other thing, as you say, is secular growth is a good area to look at as well. So healthcare, areas like that.
Well, just on that healthcare, I mean, I know it's a singer's stock, but I've interviewed the CEO, Adam Hill of Oncimmune. And can you just walk through that? Because what fascinated me about that particular company, it's a global immunodiagnostics business, but they've just reached an inflection point. Their Immuno Insights sort of like service, which helps large pharma identify new compounds and testing and stuff like that. It could triple revenues this current year.
Yeah, I think they've got great customers like Roche and Genentech there already. They're increasing the capacity, I think, which is probably what you're referring to. So it's going to move up.
That's out of Dortmund, isn't it?
Yeah, 40,000 samples per year. Now they get about £1,000, give or take, a sample. So you can see the potential there. They've got a lot of potential in the 150 plus in the pipeline in terms of deals to come through. And let's be honest, they did have a relatively slow first half. But what they're seeing is
first quarter.
First quarter, yeah, and it's picking up now, basically. I think so. So I do think that it's a leader in its space. You've got global pharma as customers, which obviously ticks the box if they're buying the screening they can do, and the market is kind of going their way. So again, a secular growth area. Healthcare, the governments have got to spend more on healthcare. We've all going to be spending more on healthcare going forward. So
and pricing power is going to be good. And I would say investors have a look, because they're going to. Yeah, I think Singer's out there at the moment. They did about 4 million of just under 4 million of turnover last year, and they're predicting around about 12 this year. And on that basis, the drop-through rate for the Immuno business is over 80% EBITDA drop-through. So you get huge operating leverage. And when I say it's an inflection point, it's going to be hopefully FY22 is going to be the first year that they make EBITDA profits, and it's going to be sort of like moving into cash flow the year after. So this could be a real sort of like major sort of transformational year for the business. And I know Adam told me basically his pipeline was really bulging. So
160 plus, so I'm told by the analysts here. 160 plus potential deals. Another
one of the secular growers. I know you like e-payments and m-commerce, because it's Bango is a company.
Yeah, Bango we had a meeting with recently, and I've seen it a number of times over the years, and it's kind of not quite got there. But I came out of that meeting thinking it's coming of age now, and the reason is really they've got three kind of revenue streams: transactions, which is where obviously they got all the mobile people signed up, and they undertake the transactions for them. They've got the platform that they get paid for the platform. But the new area they've got is marketplace. Now, obviously, things are changing in terms of cookies, and Apple are changing that, and the whole targeting of marketing. Now, the mobile is a new way that people can target now, because your mobile number is basically encrypted. But because they do the transaction side of it, Bango, they can do very targeted advertising campaigns for people. So I don't know, let's use an example that you buy Netflix and you pay for it on your mobile, the subscription on your mobile. Well, say Disney comes to you and says, I want to get people who like subscribing to online TV. Well, there you go. You can look at your anonymized data and already know the people who you can target. So, and also what's happening as well is bundling. So Vodafone, you see it now. Well, Sky's the example I use. If you've got Sky, then you'll have your Sky TV, then you might have your Sky broadband, then you'll have your Sky phone line if you've still got a hard phone line, and then Sky will say we can give you Netflix as well, and we can give you Disney through the Sky as well. So bundling, and why do they want to bundle? It makes it a lot more sticky, the revenue. People don't tend to drop off. So what Bango can do through their marketplace is they take a percentage of the spend, and then they send out the marketing texts, the emails, whatever it might, SMS, whatever it might be, the offers. So that's a great offer. And what it does as well, it takes them outside their mobile universe where they are at the moment into, they've already got 2 US retailers signed up, for example. So that's actually, quite exciting, I think, for them. So it's early days on that, but the marketplace is already generating revenue. Interesting stock to look at, I think.
Just on the valuation, how do you actually? Because I did notice it's not about 8 or 9 times sales, isn't it? I mean, it's not the cheapest of stock, so there is actually. It's one of those.
The sector trades like that. I mean, it has traded like that, but it's traded like that for quite a long time. But what I think you talk about inflection point. I think that rate of growth now could pick up quite rapidly now. That's why that if you see that happening, then the shares won't, they won't stay around this level. If they start reporting that they're signing up more and more, because you think about it, they're in one vertical, and if they've added retail, and they could add on healthcare, and because all these guys want to do targeted marketing campaigns, and bundling, and the whole. I think the market has come before they were pushing into the market. Now they're getting market pull coming through. The combination of those two things together can be very powerful, as we all know.
Yeah, no, I would agree. And another one which is basically in that space, which is a bit cheaper, is EQLS Group, which is a platform for forex and international payments for B2B companies, and that has just absolutely the sales have just rocketed over the last couple of quarters as the economy's reopened, and that one's in a really good space. It trades at around about 2.8 times sales, and is artificially depressed because its largest shareholder, in my view, Crystal Amber, is probably going to have to sell. So it's a stock anchor. So if you want, I mean, all I would say is if people want shares, it's one that should be available, but they're really cheap, but the growth is just enormous. And the key bit to remember for investors in this space, it's a platform. The drop-through rates are great, and the technology has just been so tried. It's bank-grade technology. And it just won, just to give you an indication, it just won an enormous single order last month in October of £1.5 million. It was a one-off from a large corporate to do an international payment. But that just shows you, one, the sophistication that they can do and offer the services, and also, two, the actual resilience of that particular system to be. I mean, they must have placed over £100 million worth of forex for this client, easy, lot more. So another one to sort of pick over. And I'm with you. If you just in sectors, you've got obviously healthcare, which is great. You've got your secular growers, and then we've just on a couple of updates. You've got DX, which you talked about a couple of months ago, and that hasn't done much, has it?
Oh, I know. They came out with great numbers, upgrades, and the share price has drifted back. Why has it drifted back? Well, probably it's to do with people worried about driver shortages, etc., etc. But these guys pass all the increases in costs through anyway. People are coming back to the office now. We all know that. The document exchange part of their business, used by government lawyers and stuff, that's going to be picking up again. It's got a phenomenal management team there they live logistics, which interesting thing to do, but that's what you want in a business like that. That's why this business has turned round, and that's why I can see it be a multi-bagger from here. So I really like DX. I think it's a great story. The shares have done nothing on that after that update, just because the market at the moment, I mean, talking in kind of the large picture, there's quite a lot of stock around in stocks, and I'm not talking about any stock in particular. There's the flows of kind of, maybe it's just a seasonal thing or whatever it might be. The flows have kind of flicked back the other way in terms of stocks being a bit offered, but that's great because it can offer you lots of opportunities, and that's what DX would be I would pick out.
I'm with you, and I actually think it's a quality stock that it falls into the baby in the bathwater syndrome again, because I think what's happened is that investor sentiment to anything online consumer, just look at ASOS, Boohoo, In the Style, the Hut Group, those shares have just been hammered, absolutely hammered over the last 2 months. And so anything associated with delivering those parcels, whether that be Royal Mail, DX, couriers, anybody like that, the sentiment's just come out of it. But you're right, as long as you choose quality stocks at good prices, long term, they're going to do well, because there's no way, nobody's going to turn back online commerce, are they? Internet sales.
No. I mean, it's right to say that year on year, we're talking about the delta again here now. Year on year, you can't repeat the growth rate you saw last year, and you probably can't repeat the absolute number that you gave last year, because you last year was so boosted. But we should have we knew that coming into this, but when it's lack of buyers that can hit stocks, not just having sellers. So when you haven't got buyers and share prices drift back because you can't repeat it, then share prices have come off, but secular growth, online is going to continue to grow, as you just said. That's your opportunity, because looking through to next year and the year after, they'll be back on that growth tick.
Yeah, another one just on an update where I think you should fill your boots is Manolete, which I talked about I think a couple 2 months ago, which is the UK's #1 insolvency litigation funder, and it came out with interims last week, and it's tracking exactly what I said it would do, i.e. such that it won't see, the financials will see benefit towards the back end of this financial year, which is March 2022, but the KPIs are already coming through. And the CEO there, Stephen Coughlin, talked about that. He was seeing a big lift in the number of creditor voluntary liquidations, creditor liquidation, those.
It's definitely happening. You're right. The early indicators are coming through. And you bang on about the money comes through later, but the work is coming through. So the market should be looking forward to on that stock like that.
And that's basically regulatory driven growth, because it was the whole industry was totally suppressed during that sort of like 15-18 month period when there was a moratorium on liquidations, on insolvencies. So corporates couldn't be put into their sort of like creditor liquidation. So it's a huge backlog. Plus, obviously, you've got a lot of businesses which may struggle coming out of the coming out of the pandemic with lots of extra debt on the balance sheet as well. So again, it's one, the shares haven't moved, but it's one to watch. And I was running the numbers. The shares are around about £3, but I could easily see in sort of 2 or 3 years this piece. My fair value is £4.40, just based on getting back to a modest level of profitability, which is where they were with a bit of growth. So it's definitely there's plenty of. What's surprising, even though the markets are all-time highs, there is just so much value out of there. If you're a stock picker, then there's lots of areas that you can protect yourself from inflation, from sort of like all the other angst in terms of potential deltas or whatever it is. But there's lots of long-term value that you could do really well for your portfolio. Is that how you see it as well?
I think so. We mentioned a number of stocks there, and I think with Manolete, they got FRP as well, who's in that space. So yeah, I think there is, and especially now, the last few weeks, we've seen some quite sharp price reactions in companies. So now is the time really to go out and trawl through and to find those companies that they might come up in stocks for 22 lists and things like that, because stocks are off just on lack of liquidity and stuff like that. And offering opportunities looking forward, because the one thing I think maybe to finish on is that if we're right about inflation and what's going on there, again, as we've said before, bonds, you want something you're going to get a return from. And what index-linked gilts are yielding something like -3, -4. I mean, fine if you buy those if you want, but I'd much rather be in equities.
Yeah, and I think that's essentially where the losers are going to be when we rebalance the economy. It's not so much the consumer which is going to lose, it's the bondholders. Anybody who's a lender, who's basically all in cash, those guys are going to lose in real terms very heavily. So just finally on the last question, over the next month, are we going to get a Santa rally? We've got Black Friday in 18, sort of like 8 days time.
Well, it's difficult. It's funny, isn't it? Because US is always on a rally. It goes up every day. And UK, we just struggle. We just seem to be struggling a bit. And it's those inflows again. People aren't putting money into the UK market. I would hope so. I think that we'll kind of, I think the IPOs are now drying up. There won't be any more now between now and Christmas. So that's good. So fund managers can focus back on, as we've been talking about, stocks, ones that have been left behind, and can come back into the market and can actually start putting the market back up. It didn't help that the Bank of England didn't move when they should have done, in my view. So now the next meeting's the 16th of December, and just before Christmas, they're probably going to go to 25. They're going to move up to 0.25% interest rates, which is neither here nor there. They should have done it before, so they put their marker in the sand. But they're probably going to have to do it then if the data continues like it is. But I don't think everyone knows that, so I don't think that. Hopefully, we are going to get that Santa rally come through. Yeah.
And even if we don't, there's going to be plenty of the barbarians knocking at the gate, because overseas buyers must be just sort of like salivating at the quality assets.
Yeah, it's been quiet for a little while, so I imagine people will be lining them up again. Yeah.
All right. Well, thanks very much for your time, Jamie, and look forward to hearing the Christmas predictions in a month's time.
Yeah. All right. Great, Paul. Thanks a lot.
Bye.